You are standing at the register, the total pops up, and you realize you are short. Payday is still 5 long days away. The anxiety hits, that familiar knot in your stomach. But then you remember the financial app on your phone. You open it, tap a button, and within seconds, $100 lands in your checking account. It feels like magic. It feels like you just unlocked your own hard-earned money early. But have you ever paused to ask how this actually works behind the scenes? Where does that money instantly come from, and what are you really giving up in exchange for getting paid early? When you use a Paycheck advance or early direct deposit feature through digital banking apps, you are interacting with a sophisticated blend of financial technology, automated risk underwriting, and speed-optimized payment rails. Understanding this process removes the mystery and protects your wallet from hidden traps. The core underlying mechanism depends on whether you are using an early direct deposit service or a standalone cash advance app. Let us start with early direct deposit. When your employer runs payroll, they do not manually transfer cash to your account on payday. Instead, they send an instruction file through the automated clearinghouse network, known as the ACH network. This file acts as a signal telling your financial institution that a specific amount of money is scheduled to settle on a specific date, usually Friday. Traditional banks receive this ACH instruction notification up to 2 days in advance, typically on Wednesday, but they hold the funds until the settlement date to manage risk and earn interest on the float. Early deposit services change this rule. Instead of waiting for the cash to clear through settlement, the app takes on the credit risk itself. The moment the app receives the verified ACH notification, it advances its own capital directly into your balance. They effectively give you a short-term, interest-free microcredit line for 48 hours because they know with near certain probability that your employer's funds will clear by Friday. Standalone Paycheck advance features operate under a completely different model called earned wage access or cash advances. Here, you are asking for money before your employer has even submitted payroll instructions to the ACH network. How does an app safely give you money when no clearing signal exists? First, the platform establishes continuous data links to your financial life. When you set up the app, you grant it access to read your transaction history or log into your employer's payroll system. Algorithms immediately scan your historical data, analyzing recurring income patterns, average bank balances, bill payment dates, and overall cash flow volatility. The system evaluates whether your income is predictable and sets an advance limit, usually ranging from $25 to several $100s. Once you request an advance, the app transmits the money using real-time payment networks or instant debit card rails like Visa Direct and MasterCard Send. This allows funds to move in seconds rather than days. The most critical part of the puzzle is how the app gets paid back. When you sign up, you grant the service an electronic authorization to initiate an automated ACH debit on your upcoming payday. The moment your actual paycheck hits your bank account, the app's automated system executes a prioritized withdrawal to reclaim the advanced amount plus any associated costs. While this technology offers a convenient lifeline during unexpected emergencies, it introduces psychological and financial friction that every user must recognize. The immediate availability of funds creates a powerful psychological relief loop. However, taking an advance reduces the size of your actual paycheck when it arrives. If you borrow $100 today, your next paycheck is $100 smaller. This often creates a deficit for the upcoming pay period, tempting you to take another advance just to cover basic living expenses. Financial analysts call this the cash advance cycle, where a one-time emergency solution transforms into a recurring reliance on future income. Furthermore, while many platforms advertise these features as free or fee-free, the revenue structures require close attention. Apps frequently charge instant delivery fees for immediate transfers, monthly subscription costs to access advanced features, or prompt you for optional tips that function practically like high-interest fees when calculated as an annual percentage rate. A $5 instant transfer fee on a $50 advance might seem insignificant, but as a percentage of the borrowed amount over a short time frame, it represents an extremely high cost of capital. The actionable takeaway is to treat Paycheck advance technologies as precision tools rather than routine budget supplements. If you use an early deposit or cash advance app, Reserve it strictly for unavoidable short-term liquidity gaps like sudden medical costs or urgent car repairs. Avoid using advances for discretionary spending or everyday living expenses. To break the reliance cycle, aim to build a small buffer in your primary account, even $50 to $100, to absorb small unexpected costs without relying on future earnings. Understanding the technology behind these apps allows you to leverage financial tools on your own terms without compromising your future financial security.